This is the third installment in our series of Q&As, where since we joined YouTube, we've been blown away by the number of questions and comments that you've been leaving, and we are going to answer them all. So we've done 2 parts already, and if you've missed them, it's probably because you're not subscribed. So hit the subscribe button and you won't miss any more parts. Today, we are going to be talking about holiday homes and investment properties. So you've asked us so many questions, such as, if my buy-to-let property is no longer profitable, should I sell it? And what's the tax implications of that? Why might you not want to put your furnished holiday let into a limited company? Do you need to charge VAT on your holiday let? And do you need to pay UK tax on income from an overseas holiday let? So these are all questions that you've asked, and we're answering them there for you now. If you've got any questions, drop them in the comments and we'll make another episode like this for you. And as I said, don't forget to hit the subscribe button if you haven't already. So question number 1 is my buy-to-let property no longer profitable? Should I just sell it?
Well, that's what a lot of people are doing, because landlords of buy-to-let properties, particularly accidental landlords, perhaps they've had a property as a first home. They've got a mortgage on that property, and they've now, perhaps got married or are living with a partner, and perhaps they have a bigger home that's their main residence, but they've hung on to that property and they've rented it out. Now, if they're a higher rate or an additional rate taxpayer, they're no longer getting full tax relief on the interest on that mortgage. So in recent years, that's affected landlords, and there've been all sorts of people trying to do all sorts of things in order to continue to be able to claim that interest. One thing is they bought properties in limited companies and this sort of thing. So landlords are being squeezed on the tax deductibility of the interest, so that's created a problem for landlords. But we talked earlier about how inflation has caused interest rate rises. I think I read in the Telegraph interest rates were looking at nearly being 6% by the end of the year. That's what the Telegraph was saying today. So, if your interest rate on your buy-to-let has gone from less than 2% to over 5%, that could be a huge increase in your costs. And not only is it a huge increase in the cost, it's a cost that you're not getting tax deducted, you're not getting a tax relief for. So I'm seeing lots of clients, especially if they've got 2 or 3 of these, and if they're heavily mortgaged on them, they're saying, look, it's just not making any money anymore. I'm not interested in it. And so they're saying, look, well, how does it work if I want to sell this property? So they are selling the properties. And there's a couple of things to say about that. Firstly, if you do have a buy-to-let that's been at one time your private residence, then you're going to be able to get an element of private residence relief. So you're not going to have to pay tax on all of the capital gain. And again, that can be quite complicated sometimes, particularly if people have complicated personal circumstances and moved in and out of properties and that sort of thing. There used to be a great relief called rental relief, but that's gone now, so you can't claim that. So first of all, people need advice on working out the capital gain to keep that to a minimum. The second thing is if you do make a capital gain on residential property in the UK, that needs now to be reported to the revenue online within 60 days of completing on the sale of the property. So that's quite important. And again, that's something that we help a lot of clients with these days. First of all, make sure they know about it, because it's still relatively new. Not everybody knows about it. Make sure the online reporting is done properly and that they pay within 60 days. The tax rate here is 28%. Capital gains tax is 20%. We have the entrepreneur's relief, which takes it down to 10% sometimes. But capital gains on residential properties, including buy-to-lets, properties you've inherited, is 28%. So there's some of the issues that I'm seeing all the time now surrounding buy-to-let properties. These issues are being forced on them by less tax relief on the buy-to-let sector and interest rates going through the roof, not just on the buy-to-let sector, but everywhere. And landlords are saying, this business is no longer profitable for me. Let's sell. How do I sell? What's the tax if I sell? They're the issues that I'm seeing all the time now on these types of properties, Tommy.
Brilliant. Okay. Another really common question that we get, and I'm sure you do as well, is it a good idea to put my furnished holiday let into a limited company?
Okay, well, I bring that topic up. Normally it isn't, to be honest. Furnished holiday lets, if they're proper furnished holiday lets and comply with the rules, have good tax advantages. First of all, you get full tax relief on any interest that an individual will get full tax relief on interest on a loan taken out to buy a holiday let. That's different from, and they will get tax relief at their highest marginal rate. So if they're losing their personal allowances, effectively 60%, or 45 or 40, or whatever their marginal rate of tax is. And also, when you sell a furnished holiday let, you pay capital gains tax at 10%. Why are we talking about limited companies? Well, the reason that I mention it is a specific example which I thought covered off a few things that I often talk about. One, it talks about the flexibility of limited companies and how if your individual circumstances are just so, sometimes it will make sense to do things through a limited company. Now, I had a client, they were both NHS consultants, so they were quite well off, and they had identified a buy-to-let property that they wanted to buy. I think it was in Cornwall. And this was going to be quite a profitable buy-to-let. I don't know if they're doing Airbnb or not, but Airbnb, same rules as furnished holiday lets effectively. So they were going to buy this property, and we were talking to them, and they also had children who were at university, and we do this all the time. So the idea was for the limited company to buy the furnished holiday. Now, those furnished holiday let profits, if they had been done as individuals, yes, they would have got the interest deduction. They still get the interest deduction in the limited company, but they would have been paying 45% tax on those profits. And I think the profit might have been something like 40 or 50,000 a year. So it's quite substantial in this case. So we put it in a limited company, and we made the shareholders of that limited company the two consultant doctors plus their adult children. And of course, the adult children had what we call alphabet shares that I've spoken about before on the podcast, I'm sure. And the idea then was for the furnished holiday let to pay its corporation tax and then distribute its profit as a dividend. But the dividend would go to the adult children. Again, it's important that they're adult children rather than the doctors. And so rather than pay tax at probably 40% on a dividend, just under 40%, they'd probably be paying at either 0 or 8.75%. And of course, the kids can do whatever they want with the money, but what I think the doctors wanted them to do was to pay university fees and things like that. So generally, I wouldn't be buying a furnished holiday let in a limited company. But if your circumstances are such, as I've just outlined, I know that won't be everybody's circumstances. I mean, for one thing, it's great to be able to get an Airbnb that's going to return you 40 or 50,000 pound profit in a year. That's terrific. But I've seen a few of those, in Worthing on the south coast. I've got clients that, amazed how much they can make.
That is super interesting. I did not know that, so that's awesome. Another one that I have no idea to the answer to this question, so I'm looking forward to your answer, is should I be charging VAT on my holiday let?
Well, if you're over the VAT threshold, which is 85,000, you should be, because residential lets, this came up, I think, in the same instance, actually. Residential lets, if you've got a buy-to-let landlord, you'd never register for VAT. Residential lets are exempt from VAT. That's a basic thing. Furnished holiday lets, though, are not. And if you do have a furnished holiday let and you charge rent, you probably don't charge VAT, but that's probably because you're under the VAT threshold. If you've got one of these super duper Airbnbs that's charging a lot of money in the right spot and you're charging in excess of 85,000, or if you've got a couple of holiday lets and you're charging maybe 40 or 50 on each in a year, then you can go over the VAT threshold. And furnished holiday let is like a hotel. You've got to charge VAT. So again, just watch out for that. Again, I know it's not common, but some people who do go into these can get into this situation.
Awesome. Okay. Do I need to pay UK tax on income from my overseas holiday let?
Well, you do. Again, a couple of things which I've had recently. I had two doctors. One, I think, had a holiday home in Ibiza. One had a holiday home in Italy. And they'd been renting these out only in a small way. I think one of them, the one in Italy, had been paying tax in Italy on that. But this is the rule. If you're a UK resident, you're taxable on your worldwide income and capital gains. So if you've got rents in Italy, for example, even if you're paying tax in Italy, it's still got to go on your UK tax return. Now, we have a double tax agreement with Italy, which means that you'll get credit for the tax that you've paid in Italy. This chap, I think, in particular, was a 40% taxpayer in the UK. He'd paid 20% tax to the Italian government. So in the UK, he had to pay the difference between 40 and 20. But this is something that I don't know whether is misunderstood. I can easily see why a taxpayer, if they think they're paying tax in Italy, surely they think I don't have to pay tax in the UK as well. But it's cut and dried. If you're a UK resident, you're taxable on your worldwide income, and so it needs to be reported. Again, I have some clients who have property in the subcontinent, in India and Pakistan, and again, it's the same thing. Your worldwide income needs to be reported in the UK.
Yeah, and I guess a related question to that is, if you're selling your overseas holiday home, what are the UK tax implications then?
Well, I'll tell you, this wasn't actually a sale of a holiday home. This was a doctor, he's a retired surgeon who had a super property actually in Spain, and he wanted to give this to his daughter. And he asked me about it. In fact, his financial advisor brought me in and asked me about it and said, look, is there any tax implication if we give this property away? And he was amazed by my answer. And I think a lot of people would be. If you give a property, a holiday home to your daughter, you just give it to her, there wasn't a mortgage on this or anything, then the revenue treat that as if you sell it to her at market value. So he was amazed that by giving away a property to his daughter in Spain, I think this was, he was going to have a capital gains tax liability. But you do. So that's important. Giving away a property like that to somebody you're connected with, I mean, you wouldn't give it away to anybody if you weren't connected with them anyway, would you? So giving it away to a member of your family, you have a tax liability. And he had a tax liability. The property was owned half by him and half by his wife. So his wife had to do a tax return to report this tax liability. They had to pay some tax on it in Spain as well. And so they got credit for the tax in Spain, so that wasn't a problem. So again, just, it's one of those things that I think this doctor just couldn't imagine that it was possible he would have to pay tax on that. But he did. And actually, it's a potentially exempt transfer for inheritance tax as well.
So that was just one part of this 4-part series. And if you are not subscribed to our channel, you might have missed the other parts. So why not hit the subscribe button now and check out the other episodes that you may have missed. Thank you so much for watching, and thank you so much for subscribing.